Support and resistance. S&R levels are foundational concepts in technical analysis, used to identify key price levels where the market may reverse or consolidate. When combined with breakouts and the relative strength index RSI, traders can effectively identify important liquidity ranges and make informed trading decisions. Below is a detailed explanation of this strategy. 1. Understanding support and resistance levels. Support, a price level where buying pressure is strong enough to prevent the price from falling further. It acts as a floor for the price. Resistance, a price level where selling pressure is strong enough to prevent the price from rising further. It acts as a ceiling for the price. Liquidity zones. These are areas around S&R levels where large orders are likely to be placed, creating liquidity pools. Breakouts often occur when these zones are breached. 2. Incorporating breakouts. A breakout occurs when the price moves beyond a defined S&R level, signaling a potential trend continuation or reversal. Types of breakouts. True breakout. The price breaks through the level with strong momentum and volume, confirming a new trend. False breakout. Fake out. The price briefly breaks the level but reverses back into the previous range, often trapping traders. 3. Using RSI to confirm breakouts. The relative strength index, RSI, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought above 70 and oversold below 30 conditions. RSI and breakouts. Overbought, oversold conditions. If the RSI is overbought during a resistance breakout, it may indicate a strong bullish trend. Conversely, if the RSI is oversold during a support breakout, it may indicate a strong bearish trend. Divergence. If the price breaks a level but the RSI shows divergence, e.g. price makes a higher high while RSI makes a lower high, it may signal a potential reversal or fake out. Thank you for watching the video so far. The rest of the topics are much more important than the previous ones. Be sure to watch. 4th, identifying key liquidity ranges. Liquidity ranges are areas where large market participants, institutional traders, banks, etc. place their orders. These ranges often coincide with S&R levels. Steps to identify liquidity ranges. Mark key S&R levels. Use historical price data to identify significant S&R levels. 2. Look for consolidation zones. Areas where the price has consolidated for an extended period often indicate liquidity pools. 3rd, monitor order flow. Use volume profile or market depth tools to identify areas with high liquidity. 4. Combined with RSI. Use RSI to confirm whether the price is likely to break through these levels or reverse. Strategy execution. Here's how to implement the strategy. Step 1. Identify S&R levels. Use horizontal lines to mark key support and resistance levels on your chart. Look for levels that have been tested multiple times. Step 2. Wait for a breakout. Monitor the price as it approaches these levels. Look for a strong candle closing above resistance or below support. Step 3. Confirm with RSI. Check the RSI. For a bullish breakout, ensure the RSI is not overbought unless it shows strong momentum. For a bearish breakout, ensure the RSI is not oversold unless it shows strong momentum. Step 4. Enter the trade. Enter a long position if the price breaks above resistance with RSI confirmation. Enter a short position if the price breaks below support with RSI confirmation. Thank you for watching the entire video. There are many strategies to learn, so stay tuned.